there's been a lot of value across a lot of markets, but the frontier markets in general is one part of the market where you have to be very, very careful. And in Asia, a manifestation of that would be a country like Sri Lanka. They started the year on the wrong foot, easing fiscal policy before the crisis hit. And so when the COVID crisis hit and they had to try and provide support to the market, they really don't have any fiscal space to do that. And we're going to be seeing debt to GDP rising above 90%. As we go into next year. And really what the market has been missing, the sovereign bonds are priced around sort of 60, 65 on the 10-year external debt, which tells you that investors have been very, very worried about their ability to refinance debt over not just this year, but next year and the year after that. And really what we want to see from the policymakers in the first instance is them announcing a new IMF program, because if you remember, the old IMF program has ended and they no longer have that policy anchor. So that will be a really key thing that we're watching for. And unfortunately, it's being delayed by the political cycle, and really they don't have that time. It's a very dangerous strategy waiting until after the elections to announce a new IMF program, because this is something that investors are really looking for. And even an IMF program may not actually save them at the end of the day, because the IMF themselves may have the view that a debt restructuring is necessary. So it's going to be a long, long, tough road, and that's one of the markets where we're a little bit more cautious.
Okay, so Kenneth, that sounds to me like an example of don't go too far down the spectrum looking for risk, because you have to be cautious at the same time. So what's the sweet spot then? I mean, what would you recommend to those who want to take on a little bit more risk while still playing it safe?
We have some thematic trades that apply in Asia, apply in EM, have applied to some of our global strategies. Investment grade credit, you haven't really had to take an excessive amount of risk going down the yield curve to find cheap bonds. So that is something that has obviously played out. We've seen global investment grade and investment grade markets within EM and Asia performing very well over the last 2 months. We still see more value in the Asian and EM markets. I think the transmission of policy, the buying of corporate debt by the Federal Reserve probably allowed that market to recover much faster. So we see the valuations in Asia and EM as still more attractive. Spreads, the developed markets have generally sort of widened out. So that's still a trade that we like. We like currency trades. We shifted already to a short dollar stance, which at one point was fairly non-consensus. Generally, with all this uncertainty, investors have tended to look for defensive trades, and there's generally been a sort of consensus view that you want to be long dollars. So we were running sort of counter to that. We think currencies are still cheap. If you want lower volatility trades, then you maybe look at baskets of Asian currencies. If you don't mind taking a bit more risk, you can look at EM currencies. And then the other markets in Asia that we like are the high-yield markets like India, which is still a very idiosyncratic trade. We like the bond market in Indonesia, but you have to be a little bit cautious of the currency for the time being.